Well, greetings to all my investment clients. My name is Walter Maziers, your wealth manager, investment advisor, and CPA tax advisor. Just disclosure, as always, unfortunately, every time I do a recording, I have to read this disclosure. Anyone else watching this video other than my investment clients, this is not intended as investment advice or a solicitation to buy or sell any securities. Please seek investment advice from your current advisor if you're not a client of mine. So please do not rely on general information that I'm presenting in this video. Do not make any changes to your portfolios. If you want more information about myself, Walter Maziers, or Trinity Wealth Solutions, you can go to this website, brokercheckfinra.org. Just type either my name, Walter Maziers, or Trinity Wealth Solutions, and it'll give you more information about myself and the firm. Alrighty, now that we got that out of the way, let's just touch base on, I'm just going to cover broad economic news, stock market, and then interest rates, what they've been doing. So let's go to economic news, just big picture economic news. So as of December 12th, major economic news included a sharp sell-off in technology stocks. The AI kind of related slump, mixed performance of key companies. One was, I forgot the name of the company that had worse economic numbers or profits than expected. That kind of drove part of the sell-off. It's a nervous market. The markets just are trying to find a direction, which way to go. So the stock market took a little hit on Friday. Oracle is really the shares that really tumbled quite a bit and pulled technology down. Economic data still being delayed because of the U.S. government shutdown, and the Federal Reserve cut interest rates by a 0.25 percentage point. It was baked into the cake. Everybody expected that to happen. If it didn't, boy, the market would have really tanked. So they cut from 4% to 3.75. That really doesn't move the needle any. Is it going to improve economic activity? All of a sudden, people are going to start, getting loans for new homes? No, that really is not enough. They would have to do a significant interest rate cut. But the interesting thing that when they announced on Wednesday, Chairman Powell, they always have Q&A in his statement. And in his statement, he was kind of what the industry calls dovish. So there's either dovish to his comments or commentaries about the economy, or hawkish. Dovish means that, hey, we think, meaning the Federal Reserve thinks inflation is kind of under control. There's going to be no major increase in inflation, so that's a dovish stand. Hawkish would be opposite, meaning, hey, we think there's still great risk to inflation. So he took more of a dovish approach. At least that's what the experts were saying. So the market liked that, and it took off on Wednesday. But unfortunately, Friday, again, there were some bad numbers that came out and caused kind of the AI, artificial intelligence companies, to have a pullback. What the future holds, wow, it's tough to see. The market is really floundering right now, trying to find a direction. The other thing, consumer sentiment and affordability. The cost of living remains a significant issue for many households. The large retailers are noting a widening affordability, meaning people are just running out of money. And you've heard probably what experts are saying on Wall Street, the K-shaped recovery. What does that mean? If you look at the letter K, there's a line going up and then a line going down. The line going up represents the affluent consumer. And if there's a slowdown, they have enough money that their spending is not going to be significantly impacted. When I say affluent, excuse me, that means somebody's probably making, $300,000 and up, $400,000, $500,000 a year, and their spending is not going to be dramatically influenced. On the other hand, the other part of the letter K going down, which represents, so the affluent represents, I think, 10%, but these represent, I think, almost 50% of the spending in the U.S. economy, where the rest of the population is kind of in that K, depending on which line you're looking at. The lower part of the K, the more destitute those consumers are. They're just running out of money. Costs of everything is going up. Cost of food, even though it's stabilized, but still. Affordability is quite a problem. A family of four, they're making $100,000 a year. They're really struggling because of everything: insurance cost, homeowners insurance, auto insurance, just as we call the affordability, and wages are just not keeping up with the cumulative effect of inflation. So. It's a mixed bag. I mean, right now, definitely the economy is slowing more and more. You hear unemployment. People are starting to lose their jobs. Companies are not hiring. So definitely there's a slowdown. So enough said about the economy. It is a mixed bag. Just one quick reminder. The stock market does not reflect what's happening in the real economy. Stock market is really a function of if people are plowing money into the market is going to go up no matter what the economy is doing. So let's take a look at the stock market. Just a quick reminder, I always present bonds, long duration bonds, QQQ, which is technology, SPY is the broad market, and gold is precious metal. So I'm comparing those three major asset classes. Our clients, we have exposure to QQQ, SPY, and gold. So gold actually has been cushioning the downside of what happened on Friday. So if we look at technology, it was down almost 2%. The broad market was down about 1.1%. Bonds were pretty much also down about 1%, and gold actually was up about 0.5%. So if we look kind of year to date, we can see, last April, there was a pullback about almost 30%, and then the market kind of took off. There was another pullback in kind of November, but again, we kind of got out of the market because we didn't know if the market is going to have a sell-off. And then it started to recover, so we got back into the market. And now there's a kind of a pullback. The question becomes, is there going to be a year-end rally, Santa Claus rally, call it whatever you want? Again, historically, 80% of the time, the fourth quarter is up anywhere from 2 to 8%. So we have about 15 days left till year end. Is the Santa Claus rally, year-end rally, is going to come to fruition? Hard to say, but lots of experts are saying we still have the potential for a final push before year end. So we are positioned to take advantage of that, but we're very, very, very cautious with our clients' money. Enough said about the stock market. We just have to wait and see which direction eventually it's going to go. We're hopeful. And again, our technical research is saying, hey, there's still a decent probability of a year-end rally. But we'll just have to see. So now let's just take a look real quick at interest rates. This is looking at 5 years. So if we look at the charts visually, it's really, interest rates have been kind of steady. They go down, they go back up, but there's no definite trend as if we look at the entire history. Now here we definitely saw, and especially 2018, this is around COVID, a definitely trend down. So we don't have that trend, if we look at 5 years. We don't see that trend down yet. Why am I bringing up interest rates? At some point, interest rates will go down much lower, and that's where we will take advantage and get into long duration bonds. We're not there. I don't know if that's going to be next year. We just follow price and momentum. So at this point, that's it. Hopefully everybody had a great Thanksgiving, and it's hard to believe we are, I think, a week and a half from Christmas. So we'll have one more video next Saturday before Christmas. So hopefully everybody will have a great weekend. I'm sure everybody's starting to prepare for Christmas Day, present shopping, preparing Christmas dinner. We, in our family, we always celebrate Christmas Eve, Vigilia, which I'll touch upon next week. So again, thank you for watching. Have a great weekend, and we will see you next week. Take care. Bye now.